This is BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, February 17th, and today's theme is simple. Markets are allergic to uncertainty, and we've got it in three flavors: oil choke points, AI jitters, and crypto-style executive chaos.
Three flavors, like uncertainty is a limited edition ice cream. Today's special, geopolitical pistachio, overvalued AI vanilla, and executive turnover rocky road.
We'll keep it tight and useful. For each story, what happened, the simple finance behind it, and what a normal person can actually do, like today, without pretending we can predict the future.
But we can still roast the future a little, right? Because my portfolio has been acting like it heard one rumor and fainted in public.
Story 1. Oil. Headlines say crude swung around as traders weighed military drills and disruptions around the Strait of Hormuz, while also tracking Iran-US talks that are expected to resume later.
So basically, the market is watching a narrow water hallway and going, if someone slams the door, we all pay more for everything. Cool, cool, cool.
Exactly. Simple version of the finance, oil is a globally priced commodity, and Hormuz is a choke point. When there's even partial closure risk or drill risk, traders add a geopolitical risk premium. Think of it like surge pricing for energy.
Surge pricing, but for your commute, your groceries, and your entire supply chain. Uber, but it's OPEC adjacent.
Why it matters: higher oil can feed into inflation expectations, and that can change how investors think about interest rates. It also hits specific sectors. Airlines and logistics hate it. Some energy producers benefit, and consumers feel it at the pump with a lag.
So what's the move for regular people, besides stop driving and invent teleportation?
Actionable checklist. 1. Know your portfolio's energy sensitivity. If you own broad index funds, you already have some energy exposure, but it may be smaller than you think. 2. Don't hedge headlines emotionally. Hedge structurally, like keeping an emergency buffer so a temporary gas spike doesn't force credit card debt.
Don't panic buy oil stocks because you saw one scary map on the internet. Fix the basics so your life doesn't become a margin call.
A markets wrap says U.S. equity futures dropped as AI worries linger, with treasuries edging higher and gold sliding as Wall Street geared up to resume trading after the holiday.
AI worries is such a polite phrase. It sounds like the market is gently concerned. In reality, it's like, are we paying champagne prices for sparkling earnings?
Simple finance behind it. When a theme trade gets crowded, like AI, prices can run ahead of cash flows. Then any uncertainty about demand, competition, or margins makes investors re-rate the whole group. That's valuation compression. The same earnings get a lower multiple.
So it's basically like buying front row concert tickets, then realizing the band might be lip syncing. The show can still be good, but you're not paying that much anymore.
Why it matters for normal people: your retirement account may be more tech-heavy than you realize. If AI leaders wobble, broad indexes can wobble. Also, when treasuries edge higher, it often signals a mild shift towards safety, or at least a demand for ballast.
Ballast is a nice word. I call it the boring stuff that keeps me from crying into my brokerage app. What's the practical move here?
3 moves. First, check concentration. If one sector or a handful of megacaps drive most of your returns, you're also accepting most of the drawdown risk. Second, decide your time horizon. If it's long, you rebalance, you don't react. Third, if you're adding new money, consider dollar cost averaging instead of trying to nail the bottom.
So the strategy is stop auditioning for world's greatest market timer and start acting like a person with a calendar and a plan.
Story 3. Corporate drama with real financial implications. Gemini Space Station Inc. says it's parting ways with its chief operating officer, chief financial officer, and chief legal officer, just months after going public.
3 top executives leaving months after an IPO is not spring cleaning. That's the group chat is on fire.
Simple finance behind it. Leadership stability affects execution and credibility. The CFO is tied to guidance, controls, and capital markets access. The chief legal officer matters for regulatory posture and risk. When multiple roles change at once, Investors ask, is this strategy reset, internal conflict, or a response to external pressure?
And the market hates unanswered questions. It's like seeing 3 smoke alarms go off and someone goes, "Don't worry, it's just vibes."
Why it matters for regular investors. Post-IPO companies can be fragile. Lockups, expectations, and scrutiny all collide. Executive turnover can increase perceived risk, which can raise the return investors demand, which can pressure the stock price. It also matters for employees holding equity compensation.
If you work there, your RSUs just turned into a suspense novel. For investors, what do? Sell, hold, or dramatically stare at a rainy window?
A practical framework. Position sizing first. If a single high volatility name can ruin your year, it's too big. Next, look for what comes after the headline. Interim appointments, updated guidance, and any mention of controls, audits, or regulatory engagement. And if you don't have an information edge, don't treat it like a casino hand. Treat it like a risk budget decision.
Risk budget decision is my new way of saying I can't afford to be emotionally attached to this ticker. I'm putting it on a mug.
Quick recap. Oil is reacting to Hormuz and diplomacy headlines. Watch for spillover into inflation expectations. U.S. markets are still digesting AI positioning. Watch concentration and rebalance with a plan. And Gemini's executive departures are a reminder that governance can move prices as much as products do.
And your homework is boring but powerful. Know what you own, know how it behaves in a shock, and stop letting headlines drive the car while you sit in the trunk.
If this helped, subscribe for the daily briefing. Leave a rating. It's the only algorithm we can influence without filing paperwork. And share the episode with someone who needs a plan before the next headline hits.
Tomorrow, we'll be back to translate finance into human. Until then, may your oil exposure be intentional, your AI exposure be diversified, and your executives remain employed.